a new regulation, I think, after the 2008 financial crisis or something. They make up new fake rules that aren't in tune with reality, and they wonder why they're not in tune with reality. Because you can't just wish away the law of gravity, just like you can't wish away the laws of economics. It's the same thing. Even as central banks have been buying gold since 2010, it has not helped any currency. The currencies are collapsing in real terms. Hyperinflation is at the door. Why doesn't it matter? Because if the currencies are not directly convertible to a fixed amount of gold, the amount of gold on a balance sheet of a central bank doesn't matter because people won't trust it if it's not convertible, and it won't be. So central bank gold buying is really irrelevant in the long term or even in the short term now, if the end game is short term away, and it could be. So it affects the spot price, but it does not save the currency. And I believe that the moves that gold and silver will make when that is done to prevent banks like Bank of America from completely failing will be so extreme that they will shock even the most ardent of gold and silver bugs and bulls like myself. There will be no time to chase. Why gold is outperforming silver? We have this chart from Bloomberg that says buying binge. Central banks continue to buy lots of gold, and this is true. We're going to put this in context in a second. So the appetite of central banks for gold has increased dramatically since 2022. And this central bank gold buying, since they don't buy silver, silver is not worth it for them. It is too hefty of a commodity. It doesn't have enough concentration of value. Gold is the bank's money and silver is the public's money. The public has not woken up yet, but it might be the central banks have, but it's not going to help them. We'll get into why in a second. The paragraph here from this Bloomberg article to which this chart was attached says countries expanded bullion reserves by 337 tons in the 3 months through September. The World Gold Council said in a report Tuesday that follows an increase of 175 tons in the second quarter, which was bigger than the council's previous estimate of 103 tons. So central banks are buying more gold than the council, whoever that council is. I don't know what the council, who's on the council? Anyone on the council? I don't know who's on the council, but they say things and apparently it's important, whatever. So why doesn't this matter? It matters for the gold price in the short term, but it doesn't really matter in the long term. It's not going to save any currencies, and here's why it won't. This is the long-term chart of gold purchases and liquidations going back to 1950. So we see here that from 1950 to 1964, I think this is the London gold pool over here collapsing. Right here in 1968, 1969, this is when they sold a bunch of gold to try to keep the gold pool at a constant price. And that was like the eve of the collapse of Bretton Woods with gold at $35 an ounce and the closing of the gold window by Nixon. So there was a whole bunch of gold buying in the 1950s and early 1960s. And then big sales, and then pretty much nothing. There was like net sales, mostly net sales from 1968, the collapse of the gold pool, until 2009. And now, yes, central banks have been buying gold since 2009 every year, and whoop-de-doo, and it's great for gold, and that does have to do with gold's rise. It's not disconnected completely, but no, it's not going to save any currencies. So what I'm saying here is that the central banks appear to have woken up, but their moves will not save their gold derivatives, which are the currencies. They will all die. And since the central banks have woken up, it's only a matter of time until the public does, and they will buy silver, just like central banks are now buying gold. But for most of them, it will be too late because the stackers will already have what they need, and it'll be up to us to distribute it, not for other currencies, but for goods and services directly, because it will be the money by which the division of labor is maintained, and whatever remains of society after this is done is salvaged. Everything will be fine, but there will be chaos in the short term. Reverse repos. I've been following these daily, and I think they are the most important thing to keep track of now. When the reverse repos fall to zero, that is going to signal the next financial crisis at the latest, not on the day that it goes to zero, but somewhere around there. I don't want to be pinned down to a specific day here, but this chart doesn't show. This chart shows the week-to-week movements. Now we are at 1.079 trillion, which is a new low since the highs were reached in 2022, I think around here. So this is the week-to-week movements. Now, I want to show you what was happening on October 31st. October 31st is significant because it's an end-of-month day. The end of the month is typically a day when banks rebalance their books and put a lot of money into the reverse repo facility. So there's typically a spike up at end of month. So I highlighted the October end of month days for the last 2 years. and they are October 29th, 2021, because October 30th and 31st was a weekend. So this was the last business day of October 29th on that book balancing day. And reverse repos went up $117.6 billion on Monday, October 31st, 2022. See another spike here. They were up $92.169 billion. Now look at Tuesday, October 31st, 2023, this week. RRPs, even though it was a book balancing day, which means that RRPs typically go up, spike high heavily on book balancing end of month days. This did not happen here. The reverse repos were still down $338 million on the last day of October 2023, and they fell by 57 billion yesterday, which is November 1st as I'm recording this. So my point is, if the RRPs cannot replenish themselves on book balancing days, it means that they're going to continue to drain fast. And I think that drainage will increase in rate once the Treasury auctions begin again on November 7th, and the Treasury has issued its refunding requirements, and they're going to increase the size of auction. I think they plan to raise something like $776 billion net this quarter, or it could be 1.5 trillion, but whatever it's some gargantuan number that is going to drain the rest of this stuff. And when they do, there are going to be no more emergency dollars to borrow for treasuries, and interest rates are going to skyrocket. And that is when a cash run could happen in the big banks, and Bank of America could be in trouble and be forced to sell its held to maturity securities. Because what is the difference between available for sale and held to maturity? It's just an accounting gimmick. There's no law that says they can't sell these things. They just don't plan to, so they can pretend that they have it at face value, even though it's not face value. But that was a new regulation, I think, after the 2008 financial crisis or something. They make up new fake rules that aren't in tune with reality, and they wonder why they're not in tune with reality, because you can't just wish away the law of gravity, just like you can't wish away the laws of economics. It's the same thing.